Welcome to my channel. This is brought to you by Finance Foundation 101 Plus channel. To support my channel, kindly subscribe, like, share, drop comment, and turn on your notification button for my subsequent video. What I'll be talking about on today is what is investing and why it matters. Let's begin. What is investing? 1. Introduction to investing. Imagine planting a seed. You water it, nurture it, and after some time, it grows into a tree that bears fruit. That's the essence of investing, putting in resources today with the expectation of gaining more in the future. Definition. Investing is the act of allocating resources, usually money, with the expectation of generating income or profit over time. This distinguishes investing from spending, where money is exchanged for immediate consumption without an expectation of future return. 2. Why do people invest? Goals of investing: wealth creation, grow your money over time, beat inflation, ensure your money retains purchasing power, achieve financial goals, retirement, education, buying a house, etc. Passive income: earn money without active involvement, e.g. dividends. Security and independence: build a financial cushion or safety net. To invest wisely, one must understand if
money grows faster over time because you earn interest on interest. 6. Investment strategies. Different people, different goals. Strategies vary. A. Buy and hold. Ideal for long-term investors. You buy assets and hold them regardless of market volatility. B. Value investing. Buying undervalued assets. Made famous by Warren Buffett. C. Growth investing. Focusing on companies expected to grow at an above-average rate. D. Income investing. Prioritizing assets that provide steady income, e.g. dividends, interest. 7. Common mistakes to avoid. Timing the market. Trying to buy low and sell high rarely works consistently. Lack of research. Investing without understanding the asset. Overconfidence. Believing you can outsmart the market. Emotional decisions. Reacting to fear or greed leads to bad outcomes. Ignoring fees and taxes. Hidden costs can erode returns. 8. The role of inflation. Inflation decreases the purchasing power of money. If inflation is 3% and your savings earn 1%, you're effectively losing money. Investing is essential to preserve and grow wealth beyond inflation. 9. Getting started with investing. Steps to begin. Set financial goals. Why are you investing? Understand your risk tolerance. Are you okay with ups and downs? Create a budget. Only invest money you don't need immediately. Build an emergency fund. Before investing, secure your short-term needs. Educate yourself. Knowledge reduces risk. Start small, stay consistent. Regular investing, e.g. monthly, can be powerful. 10. Investment tools and platforms. Brokerage accounts, robo-advisors, retirement accounts, 401k, IRA, mobile investment apps. Choose a platform that suits your goals, experience level, and comfort with risk. 11. Ethical and socially responsible investing. More people are choosing to invest in line with their values. ESG investing. Focus on environmental, social, and governance factors. Impact investing. Invest in companies that make a positive difference. Let's get to the second part. Why investing matters. A. Personal finance and wealth building. 1. Beating inflation. Inflation reduces the purchasing power of money over time. If you simply save your money under a mattress or in a low-interest account, its value erodes. Investing helps your money grow faster than inflation. 2. Generating passive income. Investing can create income streams. Societal impact. 1. Economic growth. When you invest in companies or funds, you are providing capital that businesses use to grow, innovate, and create jobs. 2. Capital allocation. Investing channels money toward the most promising and productive uses, which can lead to societal advancement, like funding renewable energy, healthcare innovation, or education technology. 3. Ownership and empowerment. Investing enables individuals to own parts of businesses and participate in economic value creation, rather than being passive consumers. 4. Common myths and misconceptions. 1. Investing is gambling. While both involve risk, investing is based on analysis, trends, and strategic decision-making over time, whereas gambling is typically short-term and based on chance. 2. You need a lot of money to start investing. Thanks to apps and financial platforms, many investments can start with just a few dollars. 3. It's too complicated. While investing has its complexities, a foundational understanding is within reach for most people with a bit of study and guidance. 5. The time value of money. This is a critical concept in investing. A dollar today is worth more than a dollar in the future because of its earning potential. Example: if you invest $1,000 at 7% annual interest, compounded yearly, after 10 years, $1,967. After 20 years, $3,869. After 30 years, $7,612. This exponential growth is due to compound interest, earning returns on both the initial investment and the accumulated returns. 6. How to start investing wisely. A. Educate yourself. Read books, e.g., The Intelligent Investor by Benjamin Graham. Take online courses. Follow reputable financial news sources. B. Set clear goals. Retirement, home, education, wealth accumulation, etc. C. Understand your risk tolerance. Aggressive, moderate, or conservative. D. Start small and be consistent. Use dollar-cost averaging to invest regularly, regardless of market conditions. E. Diversify. Spread your investments across different assets to reduce risk. F. Stay long-term. Focused. Markets fluctuate. Panic selling is a major reason for poor returns. 7. Investing versus speculating. It's important to distinguish between investing and speculation. Investing involves thorough analysis and is usually long-term. Speculation is often short-term and based on price movements rather than fundamentals. Example: buying Apple stock after reviewing financials equals investing. Buying a meme coin because it's trending equals speculation. 8. Ethical and impact investing. More investors are aligning their investments with their values. ESG investing, environmental, social governance. Socially responsible investing, impact investing, funding companies or causes that create measurable social impact. 9. The role of emotions in investing. Fear, greed, and impatience can lead to poor decisions. Selling during a market crash, fear. Buying high in a bubble, greed. Jumping between investments too quickly, impatience. Learning to manage your emotions is key to investment success. Conclusion: investing is not about getting rich quick. It's about being disciplined, patient, and informed. Whether you're saving for retirement, a home, or just growing wealth, investing is a critical part of financial health. Start early, stay consistent, Think long term. Also, investing isn't just for the rich or the financially savvy. It's for anyone who wants to secure their future, beat inflation, and put their money to work. Whether you're 18 or 58, understanding and engaging in investing can have a transformative effect on your life and the economy. I am sure you've learned something new or more from this class. However, for better understanding on this topic, I will advise to check my previous video titled Investing 101 for Beginners. This is a continuation of it, and more so this video will also continue in another upcoming video. So watch out. This is brought to you by Finance Foundation 101 Plus channel. To support my channel, kindly subscribe, like, share, drop comment, and turn on your notification button for my subsequent video. See you all in my continuation video.